So we were doing working capital management. See, when we are talking, and we were supposed to start with the operating cycle. See, before you understand the theoretical concept of operating cycle, just have a look at this particular figure. See, what happens is we have cash in our organization, right? Whatever may be our business, we actually start with the cash. We buy raw material from that or whatever things are required in the business, right? From that raw material, we put that into the production process, and when we put it into the production process, that means it gets converted into work in process, right? That means we are talking about the semi-finished goods. So these semi-finished goods, once they are totally converted into the output of the organization, that means we are talking about the finished goods. So they get converted to finished goods, and then we sell them in the market, so they get converted to sales. Now, once they are converted into sales, there are 2 points of consideration over here. If we are selling it on credit, so that means directly these sales are converted into cash, like in the hospital industry, right? But if we are selling the product on, if we are selling it on cash, then it is directly converted into cash in hand, right? But if we are not selling it directly in cash, that means we are dealing in products which are sold on credit. Then in that case, that product gets converted first into debtors, and from debtors it gets converted into cash. So if we are dealing, or if we are just having cash transactions, then in that case it is direct cash. But if we are talking about products which are sold on credit, then it is from sales to debtors and from debtors to cash. So whenever we are talking about any operating cycle of a manufacturing concern, then in that case, this entire circle is suitable for manufacturing firm. But if I'm talking about any non-manufacturing firm, then whatever finished goods are there, these finished goods, they are sold in the market, and then they are directly converted into cash, right? Now, whenever we are talking about this working capital, what happens is that there is another concept known as cash conversion cycle. Now, when I'm talking about this cash conversion cycle, that means I'm talking about the amount of time in which the cash is occupied, you can say, or you can say cash is tied up in the overall process, and how much time does it take to recover the cash out of it, right? Or we can simply say it is the time period between the dates from when we pay for the supplies to the date when we get the amount from our customers, right? So we can directly talk about the cash conversion cycle, which is known as CCC, which is equal to OC, that is operating cycle, minus the APP, that is the accounts payable period, right? Because then only we'll come to know exactly how much cash conversion cycle will take. I mean, how much time it will take, right? And if I'm talking about my operating cycle is equal to AAI, that is average age of inventory, plus ARP, that is account receivable period. So finally, we have these formulas. That is, if I talk about your AAI, that is average age of inventory, that is average inventory upon cost of goods sold into 365 if it is number of days, and if it is number of months, then it can be 12. If it is number of weeks, then it can be accordingly multiplied, right? So similarly, average receivable period, that is average upon annual sales into 365. And see, in this case also, it depends. Like if I'm talking about here as annual sales, this sales can be either total sales or it can be credit sales, depending upon what your organization is actually talking about, right? Or what is applicable in your organization. Then you have APP, that is average average payable period, which is equal to average accounts payables upon cost of goods sold into 365, right? So accordingly, these things can be calculated. And if you just have a look, you can just see. See, what happens is, if you are starting with your raw material, which you are buying on credit, right? So you will get a receipt of invoice from your creditor, right? You introduce it into the production process. So this is the average age of inventory, right? Then what you have to do is, you have to sell the goods, and when you sell it, you have to sell it in the on credit. And when you are using the inventory, during that time you are enjoying your payable period, because you haven't made the payment yet. You have purchased the material on credit. So finally there will be a day when you will have to make the payment to your suppliers, right? Now when once you sell your goods on credit, then in that case your debtors will start enjoying the accounts receivable period, right? And there will be finally a day when you will receive the accounts receivable. That means you'll be receiving the cash, right? So if I talk about this entire process is operating cycle. And this portion where you make the payment to your suppliers, starting from that period till the time you receive the payment from your debtors, is known as cash conversion cycle. Right. Now the question arises, why there is a need to maintain the balanced working capital. See, what happens is, if you are having excessive working capital, then it is a wastage. And if you are having inadequate working capital, then you will face the shortage, which will again add to your problems. Now, starting with the dangers of excessive working capital. That means if you are having excessive working capital, then what are the dangers associated with it? First of all, if you are having excessive working capital, certainly it will lead to unnecessary accumulation of the stock, that is inventory. That means if you are having unnecessary piled up stocks, so ultimately it will lead to mishandling of the inventory. It will lead to more wastage, theft, losses. All these things will increase. Secondly, there are chances of, or you can say it will indicate that there is a defective credit policy and slack in the collection period. So as a result, you will have more bad debts, because if you are having more stocks, so you will be forced to sell at a lesser price, so that you can get rid of the excessive price. And then it will lead to huge amounts of bad debts, because you are just selling it off to anyone who is ready to buy it. And as a result, it will be decreasing your overall profits, right? Then also it means that your management is not that efficient, because they do not know how much to buy, when to buy, at what price to buy. Then it will also lead to speculative profits grow, because if you are accumulating your inventories, then that tend to make speculative profits grow. That means you are trying to go for speculation in this case. But when I'm trying to talk about the speculation basically means you are buying in at a lesser price, in the hope that in near future your prices will increase, and then and that time you will be able to sell. But in this case, that means you will have to follow a liberal dividend policy, right? Why? Because you are aware that you have ample amount of stocks, right? And rather than saying it is ample, I'll say that it is more than the required. That means you are just accumulating inventory. Because of that inventory, you'll be facing a problem that how to get rid of it. So as a result, you have to give more liberal dividend to your stakeholders, right? So as a result, it becomes a problem for your for the organization, for the management, because they are not able to manage the required situation. But at the same time, if I talk about the dangers of inadequate working capital, then first of all, it will lead to a stagnation in the growth. Why? Because you are not able to utilize, you are not able to make a profit out of every given opportunity. Why? Because you do not have the sufficient amount of working capital that is required to run your day-to-day operations. Secondly, it becomes difficult to implement your operating plans because you will not be able to achieve your organizational targets, your no, or you can say target profits. So as a result, it will, I mean, you will lose many of the business opportunities, right? Then even if I talk about the operating inefficiencies, then it also becomes difficult for you to meet the day-to-day commitments, because you know you will not be able to pay because you do not have that much capital with you. You know that you will not be able to manage the operations because you do not have that much capital that you know you can pay off your debts, you pay off your salaries on time, you pay off your utility bills, or you can manage the operations. Then it will also lead to inefficient utilization of fixed assets. There might be a possibility that you have good amount of fixed assets with you, but just because there is shortage of working capital, so you will not be able to further utilize the each and every opportunity that is there. So even if you have bigger orders at your disposal, even they will not be able to go for them because you do not have that much of working capital. That means if you're not able to manage your day-to-day operations, so no matter how good fixed assets you have, you will not be able to make use of them. Then it also hinders the firm to attract credit opportunities, right? Because in this case, you will not be, getting the, no matter there might be business opportunities, but you're not able to get out of it. Reason being because you know that you are not having a good amount of working capital, so you will always ask for credit, more and more credit from your suppliers, right? So when you require more and more credit, you know that once you get the credit, then only you will be able to move ahead with the operation. And when you get the credit, then it becomes a problem that you have to repay that credit. And also, when you face such a situation, then your reputation is at stake, the reputation of the organization. Reason being because you're not able to honor your obligations, especially the short-term obligations. So as a result, the reputation of the organization is at stake, your market reputation goes down, and it becomes difficult to survive in the market. Now, there are certain factors that influence your working capital, like starting with the first one, that is the nature of capital. See, it depends like whether you are a manufacturing concern or a trading concern. If you are a manufacturing concern, then certainly your working capital requirement is more as compared to an organization who is just a trading concern. Because if you are into a trading business, then certainly your overall working capital requirement reduces because you do not have to, get into so many other operations which a manufacturing concern gets into. So as a result, your overall working capital will be less in case you are a trading concern. And if you are into the manufacturing concern, then certainly your working capital requirement is more. Similarly, if I talk about the size of the business, then the larger the business, the larger will be your requirement for your working capital, right? So we can simply say, depending upon the size, or when I'm talking about size, that means I'm talking about the assets, the sales, right? The more assets and sales you have, the more will be your working capital requirement. And if you have more scale of operations, so accordingly, more working capital is required. And the lesser is the amount of all these things, the lesser is the requirement for your working capital. Next is the production cycle process. Whenever we are talking about the production cycles, all those manufacturing firms which have a large production cycle, certainly that means they will require more working capital, because if your one production cycle gets completed in 6 months, so that means my funds will be blocked in one cycle itself. So as a result, I need more working capital, right? But if in case my production cycle is small, that say for example, my production cycle is finished in 1 month itself. So that means after 1 month, immediately I'll be getting money. So in that case, my overall requirement for working capital is less, because in that case, I'm able to generate money frequently as compared to the organization which has large production cycle. Now, the other point can be production policy. See, in case of production policy, you have to see whether your product is a seasonal product or it is a product which is bought and sold throughout the year, right? And in that case, you also have to see that what kind of production policy you are following. So in this case, there are two options. Either you confine the production only to periods when the goods are purchased, that means in the seasonal product, or you might follow a steady production policy throughout the year, right? So in this case, you will have to see that you are going for which option. Say, for example, uh, we are taking a particular case where your production and sales go simultaneously, right? So in that case, my overall working capital requirement will be less. Like if I talk about the normal FMCG products, right? Because you know that continuously they are being produced and they are being sold. So when they are being sold, so that means cash is generated out of that. So when that cash is generated, so your working capital problem is not there, right? But if I talk about that if your sales are seasonal, but and if your production takes, your production is going out throughout the year, then in that case, your production, your working capital will be high throughout the year. Why? Because in that case, you know that you will be generating money only in the season in which your product is selling, but whereas you are using it throughout the year, so as a result your working capital requirement is there throughout the year. So in that case you will have to arrange the funds accordingly. Second, next is the credit policy, or what we call as the terms of purchase and sales. See, whenever we are talking about the credit policy, you have to see how much policy you are getting from your suppliers and how much credit you are giving to your customers. If you are getting more credit, then it is easy for you to manage in the business, right? Reason being because getting the product or buying the product is not a tedious task. But if you are not getting your product on credit and still you are giving credit to your customers, then certainly that will add on to your problem. And in that case, your overall working capital requirement increases. So accordingly, you will have to decide that you want to go for which particular option. Next is the business cycle. See, when we are talking about the business cycle, we say that the amount of working capital that is required, it varies with every movement of business cycle. And this can be studied in two directions. The first one is the upward phase. That means if there is boom in the business, in that case, more working capital is required so that you can cover the lag between the increased sales and the receipt of cash, right? Reason being because you know that immediately sales will be there, but immediate cash return will not be there. Cash will take some time to generate. So as a result, to further manage the increasing business operations, you need more and more amount of funds. So as a result, more working capital will be required. But on the other side, the opposite side of it is downsizing phase, in which the business is not in its upward phase, right? So in this case, your requirement of working capital will be less. Reason being because there is no growth in the sales. Next is growth and expansion. See, if you are having growth related, options in hand, then certainly your working capital will be more. And if your overall requirement is less, when I'm using the term less, that means you do not have ample amount of growth opportunities and expansion plans. So in that case, your overall working capital requirement will reduce. Next is the scarce availability of raw materials. Many a times what happens is that the overall availability of raw material is a tedious task. Either if you cannot get it, so you will try your best to grab the maximum share, right? But if it is easily available, that means you can buy it continuously without any interruption as and when it is required. Then in that case, it is not going to, affect your working capital in the smooth manner. Reason being because whenever you require it, you can get it. So you need not maintain a um, huge amount of you can say buffer stock for your raw material. So you can easily buy it as and when required and at the normal prices. But if in case it is scarce, then you have to see that by all means you need to maintain good amount of stock of raw material, because you know it is not easily available. So if you want to buy more and more, then that means you require more and more capital, working capital. Next is the profit level. See, firms, they usually differ in their capacity to generate profit from their business, right? So some of them, they enjoy a leading position, and that leading position is due to the quality of the product that they maintain, or maybe their marketing strategy, or maybe, I mean, they have a what do you call as, they have an added advantage in some or the other way, which will help them in earning a high amount of profit. So such firms, they will earn you can say a better profit. And if you are providing good quality, if you are having some advantage, if you are having that marketing, better marketing strategies, then certainly everything comes with a cost. Right. So as a result, but whenever we are talking about this quality and this added advantage, as I told you, there is an added advantage. So that means you are able to earn better as compared to others. So in that case, that means with the same level of capital, what others are earning, you are earning better. But when I'm saying with the same level of capital, we are earning better. So that means my overall requirement is decreasing, because to earn my level of profit, others require more capital. But I do not require that much increased capital. I require a lesser amount. So as a result, the organizations which are earning more profit, then these organizations will be requiring less amount of working capital. Next is the level of taxes. See, whenever we calculate our net profit, net profit is always calculated after tax, right? So whenever we are talking about this amount of tax to be paid, this amount of tax is actually determined, I mean, based on the rules and regulations laid down by the tax authorities. So in this case, the management, they do not have their role. They can only try to reduce the tax liability, but they do not have their role in deciding about the tax, right? So in this case, what happens is, usually, even if we talk about as individuals, we also pay our advance taxes, and same is with the companies, that they also often they pay the taxes in advance. And when they pay the taxes in advance, this is based on the profits of the previous year, because that is just a generalization, or you can say just an estimate that, okay, in the upcoming year, we'll be having this much amount of profit. So we should pay the tax uh, as of now, this much tax, right? So whenever we are talking about this payment of tax, it also requires money, right? So that means, again, your working capital is to be planned in a proper manner. So if your tax liability is increasing, so that means it is leading to increase in your working capital requirement, and vice versa. Next is your dividend policy. Now, whenever I'm talking about dividend, dividend is again paid out of profits. So that means it again has a working on your, it again has a bearing on your working capital. And you know that this dividend is an appropriation of profit. That means if profit is there, then the organization is supposed to pay the dividend. And if profit is not there, then they are not supposed to pay the dividend, right? But whatever may be the situation, if you are paying the dividend, then it is going to reduce your cash resource. And if your cash resource is being reduced, then that means your working capital is being affected, right? And if your firm is not paying any dividend and is retaining profits, then the working capital, the availability of working capital increases. That means you need not arrange for extra funds, because those extra funds are being arranged with the availability of profits, right? So whenever we are talking about the payment of dividends, or you can say the declaration of dividend, then it will lead to more working capital requirement. That means you will have to arrange more funds for the working capital requirements and vice versa. Next is your depreciation policy. See, whenever we are talking about this depreciation will also have an influence on the amount of working capital requirement. Whenever we are talking about depreciation, we usually say it is a charge, or we can say it is an out-of-pocket cost, right? So whenever we say that depreciation policy has an impact on the working capital, then it has an indirect impact. Because if I'm saying more amount of depreciation provisions, then it is going to reduce the amount of required working capital and vice versa, right? Next is your price level changes. See, increasing price levels, if your factors of production, they are becoming costly, then certainly your overall working capital requirement is going to increase, because in that case, you will have to pay more on the factors of production. If your raw material is becoming costly, if your labor is becoming costly, so all these things require payment, and if you have to make the payment, then all these payment will ultimately increase your working capital requirement. The next is your operating efficiency. Now, when I'm saying operating efficiency, it means I'm talking about the optimum utilization of resources at the minimum cost level. Because whenever we are talking about efficiency, efficiency means utilization of resources at minimum cost, right? Now, in this case, if your organization is less efficient, then that means they are wasting the resources. And if they are wasting the resources, then they require more capital, more funds. And if it is the other way around, then it has to be that they require less capital. So you have to see, if you are more efficient, then your overall capital requirement is less. If you are less efficient, then your capital requirement is more. Next is the availability of credit. See, if you are able to avail more credit from your suppliers, then you can manage with less amount of funds. But if you are not able to avail credit, then certainly more working capital is required, because you need to pay them immediately. Then there can be some other factors also, like what are your policies with respect to the coordination between production and distribution? Or maybe what is the situation of transportation and communication, right? Then maybe what is the credit policy of RBI? Because all these things are maybe not in your hands, but still they will have an impact on your overall policy. Now, whenever we are talking about this working capital, you have to determine the required working capital. And whenever we are talking about estimating the working capital, then you have to follow a 4-step procedure. That is, first of all, you need to estimate the cash cost of various current assets required by the firm, because you know that the two components of your working capital are current assets and current liabilities. So the first step is that you need to estimate your current assets. Second is your current liabilities. Third is you need to calculate your net working capital, that is current assets minus the current liabilities. Then to that, we need to add some percentage, right? We need to add some percentage of the net working capital if there is any contingency or safety working capital requirement. Because with the coming time, we do not know, many a times we expect, that this can be the, possible situation. So accordingly, we add a particular percentage to a given factor. So then we get the actual requirement of your working capital. Like you can just have a look that I've given it in the form of a statement. You start with your current assets, you write down all the current assets, then you do the total, you write down all the current liabilities, then you do the total, and then to that you add a particular contingency percentage, right? So you finally calculate your overall working capital requirement, right? So these are the various symbols that we have used for your working capital requirement. As I told you, when we are talking about the estimation of current assets involves various types of current assets, like your investment in raw material. Now, when I'm talking about investment in raw material, that means I'm talking about BP in units. Now, the question arises, what is this BP? That is production, budgeted production, right? Into RMC per unit, that is raw material cost per unit. Then into ARMHP in months or days, that is average raw material holding period, divided by 12 months or 365 days, depending upon that whether your requirement is in months or it is in days, right? Next you have is investment in work in progress, or what you call as work in process inventory. Now, whenever we are talking about work in process, see, work in process means that if suppose your work is completed, say for example, up to 50%, then in that case, only 50% labor cost and overhead cost should be taken into consideration, right? You cannot simply say that, okay, for the entire product, I have paid this much. If your product has not yet been produced, so how can you take that entire 100%? So as a result, in that case, we only consider 50%, right? So accordingly, we need to calculate the budgeted production in units into estimated work in process cost per unit into average time span of work in process inventory divided by 12 or 365 days, depending upon your requirement. Similarly, for investment in finished goods inventory and investment in debtors is also required, and your cash and bank balance. So that means we are just talking about the requirements with respect to your individual current assets. Then we talk about the estimation of your current liabilities, right? The way we have calculated it for current assets, we will be calculating it for current liabilities also. So you can just have a look at the example that we have given. From the following information of VSGR Company Limited, estimate the working capital needed to finance a level of activity of 110,000 units of production after adding a 10% safety contingency. Raw material is 78 per unit, direct labor 29, overheads excluding depreciation 58. So that makes it to a total cost of 165. Then your profit is 24, selling price is 189. Additional information is given to you. That is average raw material is in stock will be 1 month. Average material in process 50% completion stage, half a month. Average finished goods in stock 1 month. Credit allowed by suppliers 1 month. Credit allowed to customers 2 months. Time lag in payment of wages 1.5 weeks. Overhead expenses 1 month. 1/4 of the sales is on cash basis. Cash balance is expected to be 2,15,000. You may assume that production is carried on evenly throughout the year and wages and overhead expenses accrue similarly. Now, in this case, you can simply see, if I'm talking about the estimation of current assets, we have to consider the raw material inventory, right? So, okay, let me just consider the figures once again. Okay. Now, in this case, what they are saying is the level of activity is 1,10,000. So I've just taken that. Yeah. Right. So if I start with raw material, so it will be 1,10,000. Then into raw material price given to me is 78. Now, in this case, what they're saying is you may assume that the production is carried on evenly throughout the year, right? So that means, let me calculate it for weeks. So I've taken the number of weeks to be 52, right? So out of 52, the time period given to me is 1 month. So I can take it the number of weeks as 4. So into 4 by 52. So my amount comes out to 6,60,000. For work in process inventory, I'll start with that is given to me as half a month. Raw material, again, the budgeted units is 1,10,000 into, again, in case of raw material, it is 78 into half a month means 2 by 52. For direct labor, again, the same thing. But now in this case, I will take it as, it was given to me as in case of direct labor, right? But work in process, they have given us as 50%. So it will be 14.5. So into 2 by 52. Similarly, for overheads, again, it is 1,10,000 and your overheads are given to us as 58. So 50% capacity, it is given to us as 29 into 2 by 52. So the amount comes out to be this. The total of all these three comes out to this much. Then finished goods inventory, 1 month is given to us. So it will be 1,10,000 into total cost is given to us as 165. So that is now 165 into time period 1 month. So 4 by 52. Debtors is given to us as 2 months. So for debtors, it is 82,500 into, again, my total cost is 165 into 2 months means 8 by 52, right? So my cash balance required is 2,15,000. That is given to us in the question. So my total current assets are this much. I'll add all these. Now moving on to the current liabilities in the similar manner, 1,10,000 into 78, that is raw material, into 1 month, that is 4 by 52. Similarly, for the expenses, 1,10,000 into overheads are 58 into 4 by 52 because 1 month. And for labor, it is 1,10,000 into 29 into 3 by 104. So as a result, we get this figure and then we do the total of all the liabilities. Now my working capital is total current assets minus total current liabilities. This is the working capital requirement, to which they are saying there is an add-on of 10% in the form of contingency. So I just add on that much. That means 10% of this. So my overall capital required is this much. Right. So with this, we come to the end of your working capital requirement. Any doubt for working capital? Okay, then we start with the next topic that is related to investment decisions, or what we call as the capital budgeting decisions. See, whenever we are talking about the capital budgeting decisions, remember these are known by different names like your investment decisions, capital budgeting decisions, or capital expenditure decisions. Now, whenever we are talking about such decisions, that means we are talking about the expansion decisions, acquisition decisions, modernization, and replacement of the long-term assets. That means we are talking about high cost related decisions which are for long-term and which are irreversible, right? So even if we are talking about sale of a particular unit or a division of the business, then that is also an investment decision. So But if I take something different, like say, for example, if I'm talking about any decision related to changing the method of sales distribution, or maybe advertisement campaign, or maybe research and development program. That means I'm talking about any decision which have any long-term implication of the firm's expansion and benefits, and they are for long-term business. Then all such decisions are again a part of your investment decisions. So whenever we are talking about such investment decisions, do remember that such investment decisions are for your long-term assets. That means you are talking about exchange of current funds for future benefits. And your future benefits will occur to the firm over a series of years. It's not just one time. It will be over a series of years. Now the question arises, why are these investment decisions important? These investment decisions are very, very important because they help you in the form of growth, risk, funding, irreversibility, complexity. Because whenever you are taking such a decision, that is certainly related to the growth of the organization, right? You want your business to grow. That is the reason you are taking such growth related decisions. But whenever you are talking about such growth related decisions, these decisions are risky. Why? Because see, whenever you start up a business venture, certainly you started with the intention of earning profits, growing that business, but it's not that this business is without any risk. There is always a risk factor involved in any type of business, right? So that risk is always associated with the decision that you are taking. And whenever you are talking about any such decision, then there is always a problem that from what all sources you can arrange the funds, that because every decision requires investment capital. All right, you can say it's basically the funds that are to be invested. So funds related decisions again are to be taken into consideration. And do remember that if you're taking any such decision, then these decisions are irreversible. You cannot expect that, okay, I'll make the investment today, and if I do not find it suitable, I'll withdraw my money tomorrow. That is not possible. And lastly, we say that such decisions are complex, because once you invest your funds into it, then it is neither irreversible nor you cannot, it's so complicated that once you get into it, so you keep on getting involved into it. You cannot just come out of it, right? Now, whenever I'm talking about the type of such a decision, do remember that such types of decisions have a different way to classify them. One classification is in which you say that it leads to expansion of existing business, or maybe you want to go for your any new business, or you want to replace and modernize any existing machinery or existing business, right? And the other way of classification of investment is that it is mutually exclusive investment. That means not related to the present one, but altogether a new one, but in some way or the other, no doubt it is not related to the existing one, but still some way or the other, it might help you in the existing business. Then the second one is independent investment. That means it has nothing to do with your existing one. You simply are trying to expand, or you are simply trying to go for something new. The third one is mutually inclusive. Now, when I'm talking about the term mutually inclusive, that means I'm talking about whatever decision you are taking, that is solely taken with the consideration that it is going to help you in your current business, right? Now, whenever we are talking about such investment, then such an investment has an evaluation criteria. And this evaluation criteria says it has a 3-step process involved. First is that you need to estimate your cash flows, right? Because whenever you are making an investment, you cannot randomly make an investment. You also need to study that what all you will be earning out of it, right? Then secondly, you need to estimate the required rate of return, right? That means how much you should be earning with it, because you also should know about the opportunity cost of the capital. Then fourthly, you also need to apply a decision rule for making the choice. Now, how all these things will be done, let's try to figure it out. See, as I told you that in the previous slide, we are talking about the decision rule. These decision rules can be taken based on these methods, which are known as evaluation criteria or the capital budgeting techniques, right? In which the first one is the discounted cash flows criteria, and the second one is the non-discounted, right? And in this case, both the categories, they are subdivided into different methods. Like for example, if I start with the first one, that is discounted cash flows criteria. Under this, you have four different methods. That is net present value method, internal rate of return method, profitability index, and discounted payback period. Among the non-discounted cash flow criteria, we have payback period and accounting rate of return. Starting with the first one, that is payback. See, payback is the most simplest, in which you try to study the number of years that are required to recover the original cash outflow that you have done as an investment in the project. That means I'm talking about the, say for example, you started with a project in which you have invested 10 lakhs of rupees, right? So your basic criteria is that you want to know that how many years are required to recover that 10 lakh rupees. The rest, everything is beyond that. I'm not saying that I'm not going to earn anything. I'm not saying I'm not going to consider anything. But right now, my consideration is that that particular 10 lakh rupees will be recovered in how much time, right? So in this case, what do we do is we consider the payback as initial investment upon annual cash inflow. That is, initial investment is denoted as CO and annual cash inflow as C, right? So you can just see, I have taken an example. Suppose there was an initial cash outflow of 8 lakh rupees in a particular project, and it is going to generate the expected cash flows in the following years as follows. Suppose 5 years are given to you, and your cash flows given are 2 lakh, 2,70,000, 3 lakh 30, 3 lakh 80, and 4 lakh 50. So if I want to know that how much time will it take to give me my initial outflow of 8 lakh rupees. First year was 2 lakh. So that means total 2 lakh has been recovered. Second year was 270. So that means total of these two is 470. Third year is 3 lakh 30. So that means total of these three now is 8 lakh rupees. So that means my cost is recovered. So my payback period in this case is 3. But it doesn't mean I'm not going to earn anything extra. I am earning extra also. As you can see that in the fourth year, my total return comes out to 11 lakh 80,000. In the fifth year, it is 16 lakh 30,000. But my cost is recovered here itself. That is at the level of 8 lakhs. Now, moving on to the other analysis. See, when we are talking about unequal cash flows, see, whenever we have unequal cash flows, inflows, then your payback period is found out by adding up the cash inflows up to a particular level. That means every year individually we have to do the total so that we can know that, okay, the initial cash outflow has been recovered or not. But there might be a possibility in which I can say that my cash outlay was, say, for example, 20,000 rupees, and it generates 8,000, 7,000, 4,000, and 3,000 during the next 4 years. So in that case, what I can do is I can simply calculate my project's payback as 3 years plus 12 into 1,000 divided by 3,000 months. That is, certainly I require 3 years. My initial cash outflow is 20,000, right? And the cash that I'm going to generate in the initial year is 8,000, right? Then it is 7,000, then it is 4,000, right? So if I add these three, so it will be 8 plus 7, 15, 15 plus 4 is 19, right? So that means certainly the first 3 years I'm not recovering my full amount. So that means 3 years are totally full are required. So I add here 3. But in the next year, I'm going to earn 3,000, but I need just 1,000 to recover my full 12,000, so 20,000. So that is 12 into 1,000 required further upon 3,000. That will be my total earning in the next year. So that means I require 3 years and 4 months to recover my 20,000 if you want to be more precise and exact. So in this case, it is said that your project should be accepted if its payback period is less than the maximum or the standard payback period, which is set by the management. So that varies from organization to organization, what your management has decided. So as per the ranking method, it is going to give the highest rank to the project, which will have the shortest payback period, and the lowest rank to the project which will have the highest payback period. But when we talk about the various merits and demerits of this method, we say it is the most simplest method and the effects are short term. It gives you a risk shield because it says the moment my actual cost is recovered, at least my risk is covered, and anything beyond that is going to give me something extra only. So it gives us the risk shield. And at the same time, it also gives me the liquidity. That means at any point of time, I can, convert it into cash once my cost is recovered. At the same time, there are certain demerits also, that cash flows after the paybacks are ignored, because my basic objective or the basic criteria in this case is to recover the amount what I have invested. So as a result, my cash flows after my payback period or my whatever is my outflow, if once that is recovered, then I ignore what else I'm going to earn out of it. Then they do not consider even the cash flow patterns. That means they do not consider how much I'm going to earn in the first year, for how much in the second year, third year, fourth year. Because in this case, they say our basic objective is how much time is required to recover the cash outflow. Next is the accounting rate of return. The accounting rate of return, you can say, is a kind of a ratio of the average tax profit divided by the average investment. That means the average investment would be equal to half of the original investment if it were depreciated constantly. Right? So we can simply say ARR is equal to average income upon average investment. And a variation of ARR method is to divide the average earnings after taxes by the original cost of the project instead of the average cost. Because that depends, like, what exactly is given to you in the question or what all information is available. Say, for example, you have two machines available, that is X and Y, and the expected lives are given to you as X 5.5 years and Y 8 years, right? And the total profit after taxes, X, it is 1,32,000, right? And Y, it is 1,60,000. But the initial cost for X is 2,40,000. For Y, it is 3,50,000. Right? And the salvage value means basically the value that you will be receiving at the end of its life when you are going to discard the machinery. And that salvage value is given to you as nil. That means 0. So if I just try to study it now, my average profit after tax is total profit after tax, that is 1,32,000 divided by the number of years, that is 5.5 in case of X. So my average profit after tax is 24,000. Similarly, if I talk about Y, for Y, my total profit after tax is 1,60,000 divided by the number of years, that is 8. So my average profit after tax comes out to 20,000. My average investment in this case will be 2,40,000. That is the initial cost plus the salvage value divided by 2. So that comes out to 1,20,000. Similarly, for Y, it will be 3,50,000. That is the initial cost plus the salvage value divided by 2. That comes out to 1,75,000. Right? So if I'm talking about my ARR, that is average rate of return, that will be 1. That is average profit after tax upon average investment. That is, in case of X, it will be 24,000 divided by 1,20,000. That comes out to 20%. Similarly, for Y, it will be 20,000 upon 1,75,000. That is 11.43%. So in this case, we can say that machine X will be accepted as it has a higher average rate of return. So this is how we take the decision with respect to your ARR. But if I talk about the ARR with a salvage value, because many a times it's not necessary that every time you will be given a salvage value of 0. So if your salvage value is given, then everything else remains the same. It is only the salvage value that needs to be added over here. Suppose your salvage value given to you is 10,000 in case of X and 20,000 in case of Y, right? So in this case, there will be a slight difference in the calculation because you can just have a look. When I'll be calculating my average investment, as you know that my average investment is initial cost, that is 2,40,000 plus the salvage value, that is 10,000 divided by 2. So that makes it to 1,25,000, right? So moving on to the next, that is for Y, the same thing. Initial cost, that is 3,50,000 plus the salvage value, that is 20,000 upon 2. So your overall average investment comes out to 1,85,000. So my ARR will vary in this case, that is average profit after tax 24,000 upon average investment, that is 1,25,000, that is 19.2%. Similarly, for Y, if I do the same calculation, then average profit after tax, that is 20,000 upon average investment, that is 1,85,000, that comes out to 10.81%. So in this case, again, you can see that my ARR is higher in case of machine X. So as a result, machine X will be the selected one, right? So all those projects which have a higher than the minimum rate of ARR will be accepted, and all those which have a lesser than the minimum will be rejected. And also do remember, when you have to do the ranking in this case, the higher the profit, the higher the ARR, the better the project is. So that means the one with the highest rate will be given rank 1. The second will be the one which is below the first one, and simultaneously all other projects will be ranked. Now, if I talk about the merits and demerits of your ARR, again, in this case, we can say it is comparatively an easy method, or you can say a simple method of accepting and rejecting the projects. Then among the merits, I can also say that you have the accounting data available, based on which you can simply go for the calculations. You need not collect any other data, and it becomes an easy and a quick way of accepting the projects. And in this case, every year's profit, accounting profit, is to be taken into consideration. Then only you can conclude the exact acceptance and rejection. But at the same time, if I talk about the demerits, the cash flows are ignored in this case. That means if I'm talking about a particular project, then which year is giving how much profit, you are not considering that. And secondly, the time value is ignored, because they simply consider the overall profit and they do not consider the time value of money. Among the discounted cash flow techniques, we have time value of money and recall compounding and discounting methods, right? Under which the first one is net present value method, which makes more sense, because whenever we are talking about, if suppose I'm saying that I bought a building of 10 lakh 10 years back, and today I'm able to sell it at 1 crores. So I simply cannot say I made a profit of 90 lakhs, because in those 90 lakhs, I also have to consider that with the passage of 10 years of time, the time value of money has changed. Right? Or you can say, the value of money has changed over the years. So I simply cannot say that, okay, it was 90 lakhs. So first of all, whatever I had spent 10 years back in the form of 10 lakh rupees, I need to calculate its present value. And when I'll calculate its present value, then I need to make a comparison with the 1 crore, which I'm going to get it today. Right? So whenever we are talking about the net present value, we say that net present value can be found out by subtracting the present value of cash outflows from present value of cash inflows. Like I give you the example, in my example, the present value of cash inflows today was 1 crore rupees, and the present value of cash outflows means that I need to calculate the value of cash outflow that was 10 lakhs previously. And the formula for that can be written as NPV is equal to C1 upon 1 plus K plus C2 upon 1 plus K whole square plus C3 upon 1 plus K cube till Cn upon 1 plus K raised to the power n whole minus CO. CO is my initial cash outflow. If I just combine this entire bracket, so that will be summation Ct upon 1 plus K raised to the power T minus CO, right? So you can just have a look at the example over here. Assume that the project X costs rupees 2,500 now and is expected to generate year-end cash inflows of rupees 900, 800, 700, 600, and 500 in years 1 through 5. The opportunity cost of the capital may be assumed to be 10%. See, whenever I'm talking about the opportunity cost basically means the cost of foregoing next best option, right? So in this case, I'll start with C1. C1 in this case is my inflows 900, C2 800, 700, 600, 500. Now 1 plus, this is my opportunity cost is 10, so I'll write 1 plus 0.10 here. raised to the power 1. Then 1 plus 0.10 raised to the power 2. 1 plus 0.10 raised to the power 3. Similarly till 5. Minus my initial cash outflow, that is 2500. Right? So my actual calculation comes to be this way. And if I solve it, I finally get it as NPV equal to plus 225. Right? So this is my net present value of plus positive 225. There's one more example. From the following information, calculate the present value of the two projects and suggest which of the two projects should be accepted if the discount rate is 10%. Now, two project X and Y are given where the initial investment is 20,000 and 30,000. The profits after depreciation and after taxation are as follows. Year 1, 2, 3, 4, 5 are given and project X and Y are given. So when I need to consider, I just consider these years here, and in the last, I consider the scrap value, right? Then my cash inflows are given to me as for X, it is 5,000, 10,000, 10,000, 3,000, 2,000. And for Y, it is 20,000, 10,000, 5,000, 3,000, 2,000 respectively. Now, in this case, what I need to do is I need to see if I calculate the values in this manner, no, like we did it in this case. It is not easy to calculate these values, right? So what we do is we have present value factor tables, right? So when we consider the present value factor tables, we will consider it for year 1 at 10%. This will be the figure. For year 2 at 10%. This will be the figure. For year 3, 10%, and similarly for 4 and 5, right? And in this case, even for the scrap value, that will be my 6th year. It is 5th year itself, because it is not going on to the next year. It is the 5th year itself, right? So now what will I do is I'll multiply it with the respective inflows. Like say, for example, for X, it will be 5,000 into 0.909. This is the value. Then for year 2, it will be 10,000 into 0.826. This will be the value. So similarly, for all the years, I'll be doing it, right? Then similarly, I'll be doing it for project Y also. For year 1, for project Y, it will be 20,000 into 0.909. Similarly, 10,000 into 8260, 0.826, and all these things will be calculated. Then we add all these. So my total present value initial comes out to 24,227, and my investment for X was 20,000. So that gives me a net present value of 4,227. Similarly, I do it for Y. You can see project Y has a better net present value because it is higher. So as a result, project Y should be selected. So as a result, if I talk about the acceptance rule for this NPV, then we say that the project which has a positive NPV should be accepted, and a project which has a negative NPV should be rejected, right? Now, when you have a particular NPV of equal to 0, then you can either select it or you can reject it. That gives you a choice. I mean, that is your discretion, right? So we can say that this NPV method can be used to select between mutually exclusive projects. So as a result, that means the one with the higher NPV should be selected, right? So if I talk about the selection criteria, or you can say the evaluation criteria for NPV, we say that NPV is the most acceptable investment rule. Reason being, because it takes into consideration your time value of money. It will measure your true profitability, because it is, when it is considering the time value of money, then it is giving you the true profitability. And it is also taking into consideration the value additivity, because every year the time value of money is changing. So it is giving that additivity consideration into each year. But at the same time, it is also having certain limitations. Like when I'm talking about the cash flow involved in each and every year, then it is based on estimation of the cash flows. There is no hard and fast rule that this exactly will be the consideration, the exact cash inflow, depending upon what will be the exact situation, because you cannot predict everything with a 100% accuracy. Then at the same time, when we are considering the discounting rate, it is not so easy to consider the discounting rate, because this discounting rate is again based on our own understanding. But it is not necessary that this is the 100% foolproof method, right? Then moving on to the next method, that is profitability index. Now, see, when we are talking about the profitability index, we say that it is the ratio of the present value of cash inflows at the required rate of return to the initial cash outflows of the investment. That means whatever will be your inflow, we are trying to calculate the present value of that divided by the present value of cash outflow that you will be making, right? So if I just take the example that the initial cash outlay of a project is 1 lakh rupees, and it can generate a cash inflow of 40,000, 30,000, 50,000, 20,000 in year 1. To 4. Then further assume a 10% rate of discount. The present value of cash inflows at 10% discount rate is, you have to calculate that. See, if I'm calculating the first year corresponding figure, then it will be 40, because in the first year the inflow is 40,000. So 40,000, then PVF, that is present value factor of year 1 at 10%, plus present value factor of year 2 for 30,000. That is again at 10%, similarly for year 3 and 4. So if you calculate the figures, you get the value as 12,350. Why? Because my NPV in this case is 1,12,350 minus my actual outflow, that is 1 lakh. So my NPV is 12,350. If I want to calculate my profitability index, then my profitability index will be 1,12,350 upon 1 lakh, that is the initial outlay. So my profitability index comes out to 1.1235. Although it's not necessary that you need to calculate it up to 4 decimal places, even 2 to 3 decimal places are fine. If I continue with the same example which we took it in the last case, but if I want to change the method of calculation, then in that case you can just have a look. Till this point my calculations remains the same, right? But when I need to calculate the profitability index, then for X, my profitability index will be the present value of cash inflows, that is 24,227 upon the actual outflow, that is 20,000. That makes it to 1.21, or I can say 121%. Similarly, I can do it for Y also. That is present value of cash inflows, that is 34,728 upon actual investments, that is 30,000. So my profitability index comes out to 1.16, or if I want to calculate it in percentages, then 116. So we can say that in this case, X has a better profitability index because the percentage is 121%. So it is recommended to go for project X as compared to project Y. Rather, you can say it is project, or if it is a machinery, then machinery X will be preferred over Y. Right. So in this case, if I talk about the acceptance rule, then we say that among the profitability index, you can accept the project which has a profitability index greater than 1, and reject the one which has a profitability index of less than 2. So you can see that in this case, both our projects, they have a higher profitability index that is more than 1, because in this case it was 1.21 and in this case it is 1.16. But as far as any particular project is concerned which has a profitability index of equal to 1, then in that case you have a choice whether you want to accept it or reject it, right? But if you have a project with a positive NPV, that will always have a profitability of index equal to that will be greater to 1, greater than 1, and profitability index less than means that the project's NPV will be negative. So with the given NPV and PI, you can calculate the other one. Then your next method is internal rate of return, that is IRR method. So in this case, it is the rate that equates the investment outlay. That means your initial outflow with the present value of cash inflows that will be received after one period, right? So that means this also implies that the rate of return is the discount rate which makes your NPV equal to 0, right? So that means all these inflows will be equal to the present value outflow, right? So you have to equate it. So when you have to equate it, so you have to equate it in such a way that this is equal to this. That means they are equal to 0, right? And that means we are talking about a particular rate of return on which the discount rate will make the NPV equal to 0, right? So CO means we are talking about your initial cash outflow, which is equal to C1 upon 1 plus R. This is year 1, year 2, 3, and till year N, right? So we can simply say that summation T equal to 1 to N CT upon 1 plus R raised to the power T minus CO will equal to 0, right? Now, in this case, when we are talking about internal rate of return, you have to consider the level of cash flows. Now, let us assume that an investment would cost rupees 20,000 and provide annual cash inflow of 5,430 for 6 years, right? The IRR of the investment can be found out as NPV equal to minus 20,000. Why minus? Because this is my cash outflow initially, plus 5,430, which is my annual cash inflow, for which you need to calculate the present value of annuity. See, till now I was using PVF. Now in this case, I have used PVAF. This A stands for annuity. Why annuity? Because in this case, we are going to get the same amount of inflow over a number of years, right? If this is the situation, that means when you're going to get an inflow of same amount over number of years, then it is considered as an annuity, right? So in that case, we do not consider the present value factor table, we consider the present value of annuity factor table, right? In a similar manner for 6 years. But in this case, we do not know that R. So as a result, I have marked this R as R only because I need to calculate this, right? And I have I have to equate this equal to 0. So if I keep on solving this, so that will be 20,000 equal to 5,430 present value of annuity factor for 6 years, where R is equal to a question mark, basically, that you need to calculate. So when you will be considering the table, you will be considering the table for 6 years. And in 6 years, you will see a value that is equal somewhere near about to this particular value, right? So you can see when you calculate it, you get the value as 3.683. So you have to equate it to this particular level, right? So when you consider it, you can see that you are going to get the values like this. Your cash flow are this, that is given to us. Your discount rate is Here though it is certainly 0, reason being because this is the you can say present situation, right? So then it will be 5, 10, 15, 16, 20, 25. So if we just multiply them, you get this NPV as these are the given values. And if you just plot it on the graph, then you can see this will be the graph that you will be getting, right? So similarly, if I have a question, a proposal which will require investment of 22,000 is under consideration. It is expected to generate cash flow of rupees 12,000, 4,000, 2,000, 10,000 from year 1 to 4. Find the RRR of the project and suggest if it can be accepted if the required rate of return is 8%. Right? So see, 4 years are given to you and cash flows are also given, right? Because it is 12,000 in the first year, then followed by 4,000, 2,000 and 10,000. Then the present value factors are given to you at the rate of 10%. Is 0.909. This you will be calculating it based on your present value factor table. Then accordingly you will multiply and you will get the present value of cash flows. That is 10,908. Then you have 3,304, then 1,502 and 6,830. So your total comes out to 22,544 less the cost that is to you of 22,000. So finally, so your cost is 22,000. So finally, your NPV comes out to at the rate of 10% is 544. Similarly, if I do it for 12%, 8% is given to us. So we will be calculating it for plus and minus side both, right? So this is at 10% and at 12%. Similarly, for 12% again, we have 12,000, 4,000, 2,000 and 10,000. So if I multiply it accordingly, then I get the values as 10,716, 3,188, then 1,424 and 6,360. So my total value comes out to 21,688, and from which I'll subtract the my actual cash outflow. So you can see in this case, my answer is coming out to be a negative answer, right? Because I'm getting minus 300 minus 312, right? So we can say at 10%, it is positive, that is 544. So we can now discount it by a higher rate, that is 12%. So when I'm talking about IRR, IRR is L, that is the lower percentage, that is 10, plus NPV, that is 544, divided by NPV plus, that is this one. I mean, NPV plus is your 544, which is the positive figure, and NPV negative is your 312, which is a negative figure, right? So accordingly, we'll calculate it. So we get our IRR equal to 11.27%. So in this case, if I talk about the acceptance and the rejection rule for IRR, it says that you can accept the project when your R is greater than K, right? And reject it when your R is lesser than K. And if your R is equal to K, then you may accept it or reject it. And in case your projects are independent, then IRR and NPV rules will give the same results if the firm has no shortage of funds, right? So accordingly, you can go for any one of them, right? And it says that if your IRR is greater than your WACC, right? So in that case, then the project's rate of return is greater than its cost. Some return is left over to boost shareholders' return. Say, for example, if your WACC is 10% and IRR is 16%, therefore it is profitable because certainly your IRR is at a higher end, right? So if I talk about the overall evaluation criteria for IRR, we say it has the following merits. It is considering your time value of money. It is also taking into account your profitability measure. And at the same time, it is also considering the acceptance rule. But if I talk about the demerits, in case of demerits, I can say that it has multiple rates. So I mean, it's not that easy. You have to take into account various things. It is not that easy that, you can simply calculate it, because you have to consider a rate higher, a rate lower, this is fine or not. So whether it is going to give me the correct result or not. So there are so many things that you need to take into account. And at the same time, the value additivity is there, which is again not so simple to consider. So if you want to get good results through your IRR, then that means you need to have thorough knowledge about it, right? Then it also says that NPV and IRR, they will always lead to the same accept or reject decisions in case of independent projects, right? So as a result, in this case, if you want to go for it, you can simply show that if you are plotting it and your IRR, if your IRR is greater than K and your NPV is greater than 0, then you can accept it. So I'm talking about this pink portion, right? But if in case your K is greater than IRR and your NPV is less than 0, that means in this blue area, then in that case, you should reject the project. So this is the point where your IRR is actually intersecting. Now, if I talk about NPV versus PI, that is profitability index. Now, there might be a conflict that arises between the two methods if a choice between mutually exclusive project has to be made for. Say, for example, you have two projects, project C and D, right? And present value of cash inflows given to you is project C is 1 lakh and project D is 50,000. Initial cash outflow is 50,000 for C and 20,000 for D. NPV 50,000 for C and 30,000 for D, and your profitability index is 2 for C and 2.50 for D. Now you have to see which one to go for, right? So in this case, you can see if my profitability index is higher in this case, that is in case of project D, then certainly I can see there are differences. So in this case, if I want to make a judgment, or if I want to finally decide, then in that case it will be this one. D1 will be the better option because it has a higher profitability index, and certainly which the one which is going to give me a higher profitability, certainly that should be the selected one, because that is going to give me the maximum amount of profit, right? And if I'm talking about any particular project, the one which will give me the maximum profit is certainly the better one. So with this, we come to the end of this chapter. Anyone having any doubt?
No, ma'am.
Okay. So in that case, we can start with the next topic, that is sources of short-term and long-term finance. At least we can just start with it. Rest of the things we can do it later on. Okay, now starting with the sources of short-term and long-term finance. See, whenever we are talking about the finance, finance is the basic requirement of any business. And as a result, we consider it as the lifeblood of the business. We cannot move ahead without finance in the business. So, and whenever we are talking about finance, that means we are talking about the funds, or you can call it as money, or you can call it as capital that is required for running the operations of business. Now, when I'm talking about these operations could be related to the day-to-day operations, right? Or it can be related to the long-term assets. It can be related to the working capital. It can be related to anything. But finance is required at every stage, starting from the promotion of the business. That means when you actually think of starting the business, and till the date you reach your liquidation. Liquidation means when you start thinking about winding up the business, right? So, and whenever we are talking about finance, do remember that you cannot just randomly raise finance. You should see that you have the appropriate amount of finance. Because if you do not have the appropriate amount of finance, then you will be either facing a shortage, or it will be idle funds. And these idle funds, they do not come free of cost. They always come with a cost attached. And if you're going to pay off the extra cost without adding anything to the earning, then your business will be suffering losses because of that. Right? So promoters means the people who start with the concept of starting the business or starting the company. They need to calculate the amount of financial help required through a proper financial plan, based on which you will get the exact amount how much funds are required. Right? So that means we can say that there is a proper financial management that is required at every point of time, right? So that means you should be very familiar, you should be crystal clear about the sources and your application of funds, right? So whenever we are talking about these funds, you know that these funds are going to affect your profitability, your growth, your survival, right? Everything. So as such, you have to be very careful when you are dealing with the finance. And do remember, if there is no finance, then there is no business. You cannot expect that, you'll be just running your business without any funds required, right? So there has to be a particular purpose of business. Without the purpose, you cannot actually just randomly use the funds, randomly use the finance, and randomly move ahead. Right. Now, whenever we are talking about business financing, do remember that business finance means we are talking about a process of raising funds, providing funds, and managing the funds. Because all these three things are related to your business activities. You are not going to use these funds for any other purpose. You are going to use it for your business only. But do remember that you are talking about raising it, providing it, and managing it. Because all the three things are very much necessary. I cannot expect that, without raising the funds would be made available. No, funds will not be made available. You have to take appropriate actions for that. Secondly, I cannot expect once the funds are raised, then it will be used accordingly. No, You have to provide it. You have to allocate the funds to different units, departments, or different requirements. And once you have allocated them, then you have to manage them in a proper manner. You cannot just let them use the funds randomly without any proper consideration. Also, do remember that whenever we are talking about this business finance is required for conducting the business activities. So you should be very careful while using it. And this business finance is required not only for any one particular purpose, but for fixed as well as working capital requirement. So accordingly, a distinction is to be made between the two, right? So we say that whenever we are talking about the money that is required for carrying out the business activity is known as business finance, then we can say that this business finance can be categorized, right? Or you can say it can be, before categorization, it can be defined as the activity related to planning, raising, controlling, and administering the funds that are required in the business, right? So whenever we are talking about this business finance, first of all, that means it is going to deal with the financial aspect of the business. Secondly, it is also concerned with the estimation, collection, utilization of funds. Thirdly, it needs proper planning and control. I told you it is not just like randomly I can say that okay, I want to raise 10 lakhs of rupees. No, because if that 10 lakh doesn't suit my requirement, say for example, my exact requirement is 12 lakhs, and I just randomly say that okay, I want to raise 10 lakhs. So no matter I might be able to raise that 10 lakh rupees, but that is not going to serve my purpose because I'll be facing another shortage of 2 lakh rupees. And if I'm going to face that shortage, then that means ultimately again that problem will be there that I will not be able to manage my business, first of all. Secondly, if I say that my requirement was 8 lakhs and I have raised 10 lakh rupees, so that means 2 lakhs is of no use to me as of now, right? But still I have raised it. And if I have raised it, then certainly that is going to uh, come with a cost. And if that is going to come with a cost, then in that case, I'll have to pay that cost. No matter this 2 lakh is not going to give me anything extra in return, but still I have to pay the cost on it. And if I have to pay that extra cost, then that means I have to pay that cost out of my pocket because this extra 2 lakh is not going to generate any money for me. So that again is the problem for the business. So as a result, whenever we are talking about such delicate issues related to the funds of the business, then we have to be very careful and we cannot just randomly quote a figure. We have to be, we need to plan in a proper manner, and we used to control its spending so that we can take an appropriate action as and when required. Then next is your objective oriented activity. Certainly it has to be objective based. As I told you, you cannot randomly raise funds. Whenever you are raising funds, you have to see that it is for a purpose. Then major aspect of the business management, because whenever we are talking about business, you know it that business is going to conduct its activities with the help of money only, right? So everything that you do in your business is being done with the help of money. So you cannot just spend or waste money. You have to see that you use it objectively. You have to see that it is a major part of your business management, because the major part of any business is to manage its finance. Because if your finance is managed properly, then it is usually considered that everything else will be taken care of. Then it is dynamic in nature. As you know, that business, once you have raised money, it is not going to stay in your business just as it is. So in this case, you have to see that once the money has been raised, how you are going to use it, what is to be done with that money, whether you should spend it, and if you want to spend it, then how it has to be spent it, then what all purposes, for what all purposes money is required, what all requirements are there in the business, and based on those requirements, how much money you have, how much is to be arranged further, and all these things are to be taken care of. Then further, as I told you, that business needs different types of finance. As I told you need finance for short term, for long term, for medium term requirements, and accordingly, taking that into consideration, the different things are different kinds of finances are to be raised. You also need to see that which particular kind of requirement is financed by which type of fund, so that you can actually manage your requirements. Because if I'm talking about the different sources, these different sources are also again not free of cost. There is always a cost attached to it. So you have to see what exactly is to be done. Excuse me. Then if I talk about the role of business finance in an organization, see, if you do not have finance, you cannot survive. If you do not have finance, you cannot be profitable. And if you do not have finance, you cannot grow in your business. So if I'm talking about the role of finance in business, then that means it is going to affect the survival, profitability, and growth of the business, right? If you want to promote your organization, for that also you need finance. If you want to you want that there should be organized way of functioning of the organization, then again finance is required for that. So as a result, we say that finance is the backbone of your business, and not only your, rather every business. And it is the finance that is going to bring stability in the organization. Even for your expansion, your modernization, and diversification process, you require finance, and that finance can be the, again, backbone of your business. Then even the if I talk about the functional areas of your finance, maybe you're talking about you want to plan something, you want to organize the resources, you want to arrange the staff members, for each and everything finance is required. Even if you want to go for your wealth maximization, even then your finances required, right? So we can ultimately say that your business finance is helping you to solve each and every problem related to your business. And without the help of finance, you cannot think of anything happening in the business, right? Now, whenever we are talking about these finance of the business, there are certain principles related to the business finance, that is full utilization of funds. As I told you, if your funds are lying, if you have raised the funds and your funds are lying idle, so ultimately it is adding to your cost. You will be the one who will be suffering a loss because you have to pay a cost attached to it. So make full utilization of the funds. Secondly, there should be maximization of return on investment. As I told you, that return on investment, or what we call as the ROI, means the return that you will be getting on the amount invested in the business. So you should get the maximum amount of return, because if your rate of return is less as compared to your cost, then certainly you will be suffering losses in the business. That will ultimately affect your profitability. It will increase your cost, and it will ultimately affect your survival in the organization. Then, if you want to survive, if you want to prosper as a business unit in the market, then you should have your business finance. When I use the term business finance, do remember it is always the appropriate and the sufficient amount of finance that is required for running your business. Then also do remember that just raising finance is not sufficient. There has to be a fair balance between the liquidity and the profitability. When I talk about the liquidity and the profitability, it means whatever funds I'm raising, I should be earning a fair return on that. That is related to profitability. And once I have invested these funds in the organization or maybe in some project, then I should have a proper liquidity on that. That means I should be able to convert it into cash. When we say to convert it into cash, it doesn't mean that at any point of time you should be able to convert it into cash, but certainly that after a particular time period, you should be able to liquidate your investment, because if you're not able to liquidate your investment, then that funds remain blocked in your project throughout the lifetime of the business, and that will create a liquidity problem for you in the long run, and you will not be able to uh, arrange the required funds and arrange the required finance as and when it becomes due for payment, right? And if I talk about this business finance, do remember it is also related to your public image. So raise your funds judiciously and raise your funds with a proper planning, because if you are not raising your funds in a proper manner, then and you are raising additional, you can say extra funds as per your requirement, or if you are raising insufficient funds with respect to your requirement, then again you are going to face a problem. In case of shortage of funds, you will not be having sufficient funds to take care of your requirement, and you will not be able to earn the maximum return. And in case of idle funds, you will not be able to make the full utilization of your funds. And in that case, your cost will be increasing. And if that is the case, then in that case, you will ultimately be adding to your cost. And if you're adding to your cost without adding anything to the productivity, then that means that you are not going to earn the maximum return. And if you're not going to earn the maximum return, you will not be able to survive in the market. And if you are not able to survive in the market, then certainly it will lead to a situation where you will have to shut down your business after some time period. No matter the situation, I mean, you will be able to manage the situation for some time, but then if you are still continuing with your operations, so you'll be increasing your amount of losses. And at one particular time, there will be a situation where you'll have to close down forcibly, whether you like it or not, but you'll be faced with such a problem. Now I'll be winding up the class here itself. Any other doubt?